Did you know that 11 out of the last 15 times the Fed cut interest rates, a recession followed? As the Federal Reserve gears up for potential rate cuts this September, we're about to uncover why this move might not be the economic savior many are hoping for. You might be wondering, what's the big deal? Aren't rate cuts supposed to help the economy? Well, that's what we've been led to believe, but here's the kicker. These cuts could actually be setting the stage for some serious economic turmoil. Think about it. Your financial future, your savings, your investments, they're all on the line. Are you prepared for what might be coming? By the end of this video, you'll understand why these rate cuts could trigger a recession and, more importantly, how to protect your hard-earned assets. So are you ready to peek behind the economic curtain and see what's really going on? Welcome to Econofin. We'll get you up to date on what is going on in the economy. If you have an update to share with the group, please use the word update somewhere in your comment below. Also, please make sure you give us a geographical location if that's relevant. Let's zoom in on the Federal Reserve's next move. Picture this, it's September and the Fed announces a rate cut. The markets cheer, mortgage rates drop, and everyone breathes a sigh of relief. But what if I told you this moment of celebration could be the starting gun for our next recession? The Federal Reserve plays a crucial role in managing our economy, primarily through its control of interest rates. When the economy slows down, the Fed typically cuts rates to stimulate growth. It's like giving the economy a shot of adrenaline. Lower rates mean cheaper borrowing costs for businesses and consumers, which should, in theory, lead to more spending and investment. But here's where things get interesting. The Fed's expected rate cuts in September aren't just a routine adjustment. They're a response to some worrying economic signals. These cuts will likely lead to decreases in federal funds rates, treasury yields, and mortgage rates. Sounds great, right? Lower mortgage rates could make home ownership more affordable, and businesses might find it easier to expand. However, there's a catch. Historical patterns show us that rate cuts often precede recessions. It's like the economy's version of the calm before the storm. The Fed doesn't just cut rates for fun, they do it when they see trouble on the horizon. Think about it this way, you're on a ship, and the captain suddenly orders everyone to put on life jackets. Sure, you might feel safer with the life jacket on, but wouldn't you start to worry about why you needed it in the first place? This creates a paradox in the Fed's strategy. While they're trying to stimulate the economy, their actions might actually be signaling deeper economic troubles. It's like a doctor prescribing strong medicine. It might make you feel better in the short term, but it's also a sign that something's seriously wrong. Jerome Powell, the Fed chair, recently made a telling statement. He said, "We do not seek or welcome further cooling in labor market conditions. This isn't just economic jargon. It's a clear indication that the Fed is reacting to worsening labor market data. They're seeing storm clouds gathering, and they're reaching for their economic umbrella." But here's the kicker. The current economic conditions, including rising unemployment and high debt-to-GDP ratios, suggest that the Fed's actions may not lead to the desired economic recovery. It's like trying to bail out a leaky boat. You might keep it afloat for a while, but eventually, you'll need to address the underlying problem. The Fed's rate cuts are often seen as a last resort to combat economic slowdowns. When they start cutting, it's a sign that other measures haven't been effective. This raises an unsettling question. Is the Fed behind the curve in addressing these issues? Imagine you're driving a car and you suddenly hit the brakes. The sudden deceleration might prevent an immediate crash, but it doesn't change the fact that you were heading towards danger in the first place. The Fed's rate cuts work in a similar way. They might soften the blow, but they don't change the underlying economic trajectory. So what does this all mean for you? Well, it's a wake-up call. While lower interest rates might seem like good news on the surface, they're actually a warning sign of potential economic turbulence ahead. It's time to start thinking about how you can protect your finances and prepare for a possible economic downturn. That economic turbulence, it's already here, hiding in plain sight. Have you noticed fewer now hiring signs lately? There's a reason for that, and it's not good news for the job market. While many people are still basking in the glow of a seemingly robust economy, the cracks are starting to show, and they're most visible in the place where it matters most, our jobs. Let's look at the numbers, and trust me, they're not pretty. The unemployment rate has jumped from 3.4% to 4.3% in just 1 year. That might not sound like much, but it translates to a staggering 7.1 million Americans now without jobs. That's a 21% increase year over year. Think about it. That's more than the entire population of Arizona suddenly finding themselves out of work. But it's not just about those who've lost their jobs. The ripple effect is touching everyone, even if you're currently employed. Remember how easy it used to be to switch jobs and find new opportunities? Well, those days might be numbered. Job postings on Indeed have dropped by a whopping 11%. That's a clear sign that companies are tightening their belts and becoming more cautious about hiring. Now, you might be thinking, surely this is just a temporary blip, right? Wrong. The job postings index on Indeed is now down about 45% from its pandemic peak. We're not just seeing a small correction, we're witnessing a return to pre-pandemic levels. It's as if all the job growth we've celebrated over the past few years is slowly being erased. But wait, there's more. It's not just about the number of jobs, it's also about the quality of those jobs. The 3-month moving average wage growth has dropped by 1.6% year over year, now sitting at a measly 3.2%. In other words, not only are there fewer jobs available, but the ones that are out there might not pay as well as they used to. Even Jerome Powell, the Federal Reserve Chair, can't ignore these signs anymore. He recently acknowledged the unmistakable cooling in labor market conditions. When the person in charge of our nation's monetary policy starts using words like unmistakable, it's time to sit up and take notice. Now, why should you care about all this? Because historically, when unemployment growth reaches 20% year over year, it has often preceded worsening recessions. We're not just looking at a few bad months, we're potentially staring down the barrel of a significant economic downturn. Think about it this way. The job market is like the canary in the coal mine for the broader economy. When it starts to falter, it's often a sign that bigger problems are on the horizon. Companies don't just stop hiring for fun. They do it because they're worried about what's coming next. And here's the kicker. Many people are ignoring the rapid deterioration in labor market conditions. It's easy to get complacent when the headlines aren't screaming recession yet. But by the time everyone realizes what's happening, it might be too late to prepare. While job losses are alarming, there's an even bigger threat lurking beneath the surface. Remember the 2008 financial crisis? Well, our current debt levels make that look like child's play. The U.S. debt to GDP ratio has hit a staggering 123%. What does this mean for your financial future, and how close are we to an economic meltdown? Let's break this down. The debt to GDP ratio is a crucial economic indicator that compares what a country owes to what it produces. Think of it as a nation's credit card balance versus its annual salary. Right now, America's balance is way out of whack. For every dollar our economy generates, we owe $1.23. That's not just high, it's historically high. To put this in perspective, during previous Fed rate cut scenarios, our debt to GDP ratio hovered around 50%. We've more than doubled that. It's like we've been on a national spending spree, maxing out our credit cards without a second thought about how we'll pay it back. But wait, it gets worse. Remember how your parents always told you to save for a rainy day? Well, it seems like we've collectively forgotten that advice. The U.S. savings rate has plummeted to a measly 3.4%. Compare that to the 9% we were saving during previous rate cut scenarios. We're not just in debt, we're broke. This combination of high debt and low savings is like walking a tightrope without a safety net. It makes our economy incredibly vulnerable to shocks. Think about it. If you lost your job tomorrow, how long could you survive on your savings? For many Americans, the answer is frighteningly short. Now, you might be wondering, how did we get here? It's a perfect storm of factors. We've been riding high on inflated asset prices and government spending, creating what some economists call a debt bubble. But like all bubbles, this one's bound to pop eventually. The scary part? This isn't just about numbers on a spreadsheet. It's about real people, you, me, our neighbors. As unemployment rises, remember those job market stats we talked about earlier? This debt problem becomes even more dangerous. People without jobs can't pay off debts or contribute to the economy, creating a vicious cycle that's hard to break. What makes this situation truly unprecedented is the combination of factors at play. We've never seen such high debt levels coupled with such low savings rates. It's like we're sailing into uncharted economic waters, and the map is warning of dragons ahead. So what does this all mean for you? Well, it's a wake-up call. The economy isn't just some abstract concept, it's the water we're all swimming in. And right now, that water is getting choppy. It's time to start thinking about how you can protect yourself from the potential fallout. Now that we've seen the debt bubble, let's zoom in on two markets that touch nearly every American: housing and stocks. Have you ever wondered why your home value keeps climbing despite stagnant wages? Or why the stock market seems to defy gravity? The truth is, we're witnessing twin bubbles of historic proportions. And when they pop, the fallout could make 2008 look like a minor hiccup. Let's start with housing. The current housing to GDP ratio stands at a whopping 176%. To put that in perspective, the historical norm is around 117%. That's not just high, it's stratospheric. It's like your house decided to take a rocket to the moon, leaving your paycheck back on Earth. But here's where it gets really strange. Despite declining mortgage rates, which should be music to home buyers' ears, we're seeing an 8% drop in mortgage applications. It's as if we're throwing a party, but nobody's showing up. This paradox suggests a fundamental disconnect between housing prices and actual buyer demand. Now, let's shift our focus to the stock market. If you thought the housing market was in la-la land, wait until you hear this. The stock market's price to GDP ratio is currently sitting at 200%. That's nearly triple the long-term average. It's like we're playing a game of economic Jenga, and we've somehow managed to stack the blocks 3 times higher than usual without toppling over. Warren Buffett, the Oracle of Omaha himself, has an indicator that measures stock market valuation relative to GDP. According to this indicator, the market is 63% above the historical trend line. When Warren Buffett raises an eyebrow, it's time for all of us to sit up and take notice. So what does all this mean for you? Well, it suggests that both the housing and stock markets are built on unsustainable growth expectations. It's like we're all living in a financial fairy tale where houses can grow beanstalks to the sky and stocks can turn into golden eggs. But as we all know, fairy tales eventually come to an end. The combination of these overvalued assets and the rising unemployment rates we discussed earlier creates a precarious economic situation. Historical data suggests that when assets are this overvalued, it often precedes economic downturns. It's like we're standing on the edge of a cliff admiring the view without realizing how far we could fall. What's particularly concerning is that a significant portion of our current economic situation is attributed to this dual asset and debt bubble. It's not sustainable in the long term. If economic growth slows or turns negative, we could see significant corrections in both the housing and stock markets. Take the housing market, for example. Home prices remain high despite a lack of buyer interest. It's like trying to sell ice to Eskimos. There's plenty of supply, but not enough demand. If market conditions don't improve, we could see a sell-off that makes the 2008 housing crisis look like a minor adjustment. As for the stock market, the hope that rate cuts will revive buyer interest hasn't materialized. It's as if we're trying to jumpstart a car with a dead battery. No matter how many times we turn the key, it's just not catching. So what can you do with this information? First and foremost, it's crucial to understand the true value of your assets in the context of these potential bubbles. Your home or stock portfolio might look great on paper, but how much of that value is real and how much is just hot air? So you've got a handle on your assets' true value, but here's the million-dollar question. How can you not just survive, but potentially thrive in the face of a looming recession? It's time to shift gears from understanding the problem to finding solutions. And trust me, the strategies we're about to explore might surprise you. First things first, let's talk about the elephant in the room. The Federal Reserve's decision to cut interest rates is often seen as a lifeline for a struggling economy. But here's the paradox. These cuts could actually be a warning sign of deeper economic troubles. It's like your doctor prescribing heavy-duty medication. Sure, it might help in the short term, but it's also a clear indicator that something's seriously wrong. Now, I know what you're thinking. Great, more doom and gloom. What am I supposed to do about it? Well, that's exactly what we're going to tackle. Because while the economic forecast might look stormy, there are ways to navigate through it and maybe even find some silver linings. Let's start with a fundamental principle: diversification. I know, you've heard it before, but in times like these, it's more crucial than ever. Think about it like this. If you're sailing into rough waters, you don't want all your cargo in one leaky boat. Spread it out and you've got a better chance of keeping something afloat. So what does this look like in practice? Well, one strategy that's proven effective during past recessions is focusing on essential goods and services. These are the things people need regardless of the economic climate. Think healthcare, utilities, and consumer staples. It's not the most exciting portfolio, but it's like having a sturdy umbrella in a storm. Not flashy, but definitely useful. Another avenue to consider is dividend-paying stocks. These can provide a steady income stream even when the market's doing its best roller coaster impression. It's like having a backup generator when the power goes out. You might not be living in luxury, but you've got something to keep the lights on. Now here's a strategy that might seem counterintuitive: maintaining a cash reserve. In a world obsessed with making your money work for you, keeping cash on hand might seem old-fashioned, but liquidity can be your best friend during economic downturns. It gives you the flexibility to seize opportunities or weather unexpected financial storms. Think of it as your economic emergency kit. But let's be clear, this isn't about making rash decisions or completely overhauling your investment strategy overnight. It's about being informed, cautious, and proactive. It's about looking at historical patterns and current indicators and adjusting your sales accordingly. Speaking of being informed, let's talk about a common pitfall: relying too heavily on optimistic forecasts. It's human nature to want to believe everything will be okay, but in the world of investing, rose-colored glasses can lead to some serious financial bruises. Instead, consider historical patterns. Look at how markets have behaved during past recessions. It's like studying weather patterns before setting sail. It doesn't guarantee smooth sailing, but it sure helps you prepare for what might come. So, what are some actionable steps you can take right now? First, take a good hard look at your current investments. Are they diversified enough to weather potential market volatility? If not, it might be time to reassess your asset allocation. Next, consider building up that cash reserve we talked about. Having liquidity isn't just about financial security, it's about peace of mind. And in uncertain economic times, that peace of mind can be invaluable. Finally, stay informed. Keep an eye on economic indicators. Watch for signs of market stress. Be prepared to adapt your strategy as conditions change. It's like being a good captain, always vigilant, always ready to adjust course. We've covered a lot of ground, from interest rate cuts to job market troubles, massive debt, and overvalued assets. But what does it all mean for you? Well, history is telling us to be cautious. When these indicators line up, it often spells trouble. Now, I'm not saying a recession is guaranteed, but ignoring these warning signs is like walking into a storm without an umbrella. You might get lucky and stay dry, but why take the risk? So what can you do? Stay informed, keep an eye on your finances, and don't be afraid to ask for help if you need it. Remember, the choices you make today could impact your financial health for years to come. Are you ready for what might be coming? Because in this economic climate, preparation isn't just smart, it could be the difference between sinking and swimming. Thanks for watching, and please make sure you subscribe if you enjoyed the video, and watch this one as well.